72 hours. That is how long you have before the financial system as you know it fundamentally changes. That is how long before the emergency protocols currently being activated inside 4 of the largest banks on Earth either succeed in containing the crisis or fail catastrophically, triggering a cascade that will make 2008 look like a minor inconvenience. I am not being dramatic. I'm not exaggerating for clicks. What I'm about to show you is happening right now in real time, documented in regulatory filings, insider communications, and emergency measures that these banks desperately hoped you would never discover. Welcome back to Vault AG. And buckle up, because this is the most important video I have ever made. This morning, at approximately 4:47 a.m. Eastern Time, while America slept, 4 major financial institutions simultaneously activated what is known internally as Tier 3 emergency liquidity protocols. These are not routine operations. These are not standard overnight adjustments. Tier 3 is the last firewall before Tier 4, and Tier 4 has a different name. It is called insolvency. The 4 banks are J.P. Morgan Chase, Bank of America, Citigroup, and Wells Fargo. Together, they hold over $8.2 trillion in assets. Together, they control approximately 45% of all deposits in the United States. Together, they are the backbone of the American financial system. And together, as of this morning, they are bleeding. The mainstream media is silent. CNBC is talking about quarterly earnings. Bloomberg is analyzing tech stocks. Nobody is reporting what is actually happening in the plumbing of the global financial system, because to report it would be to accelerate it. The moment the public understands what Tier 3 means, the bank run begins. But you are not the public. You are here, you are awake, and in the next 40 minutes, I'm going to show you exactly what these emergency protocols mean, why they were activated, and what you need to do in the next 72 hours to protect everything you have worked for. The clock is ticking. Let's begin. To understand what is happening, you first need to understand what Tier 3 emergency liquidity protocols actually are, because the banks have done an excellent job hiding this information from the public. Every major bank operates under a framework called a living will. This is not a metaphor. It is an actual regulatory requirement established after the 2008 financial crisis under the Dodd-Frank Act. Each too-big-to-fail bank must submit a detailed plan to the Federal Reserve describing exactly how they would unwind their operations in an orderly manner if they faced collapse. Within these living wills are tiered response protocols. Think of them like DEFCON levels for the military, but for banks. Tier 1 is business as usual. Everything is fine. Normal operations. Tier 2 is elevated concern. Liquidity is tightening. The bank begins reducing risky positions and accumulating cash reserves. This happens a few times a year and is not necessarily alarming. Tier 3 is emergency mode. This is activated when the bank's internal risk models indicate that without immediate intervention, the institution faces a material probability of failure within 30 to 90 days. At Tier 3, the bank activates emergency credit lines, begins liquidating non-essential assets, and coordinates directly with the Federal Reserve for potential intervention. Tier 4 is resolution. This is where the FDIC steps in. The bank is either seized, merged, or dismantled, and depositors face potential losses beyond the $250,000 insurance limit. As of this morning, 4 banks are at Tier 3, all 4 simultaneously. This has never happened before, not in 2008, not in 2020, not ever. How do we know this? The information comes from multiple sources. First, the Federal Reserve's weekly H411 release, which tracks the Fed's balance sheet, shows an emergency injection of $43.7 billion into the banking system over the past 5 days. This money went somewhere. It went to banks that needed it desperately. Second, the OCC, the Office of the Comptroller of the Currency, filed an unusual after-hours notification on Thursday indicating that 4 nationally chartered banks had requested expedited access to emergency lending facilities. The filing did not name the banks, but given the size of the facilities requested, only the Big 4 qualify. Third, and this is the smoking gun, internal communications leaked to financial analysts on Friday show coordinated stress testing being conducted across J.P. Morgan, Bank of America, Citigroup, and Wells Fargo, focused specifically on precious metals derivatives exposure. Let that sink in. The stress testing isn't about mortgages. It isn't about commercial real estate. It isn't about credit cards or auto loans. It is about precious metals derivatives. Did you know there's a financial time bomb ticking right under the biggest banks? And they've spent decades trying to hide it from you. It's called precious metals derivatives. These are contracts whose value is based on gold and silver. Banks use them for legitimate reasons, like helping miners lock in prices. But they also use them for massive, risky speculation. The 4 biggest U.S. banks hold a combined derivatives exposure of over $189 trillion. That's nearly 7 times the entire U.S. economy. Now, they'll say the real risk is much smaller, but here's the kicker. They're not hedged. They've sold contracts promising to deliver gold and silver they don't actually have, betting the price will go down. But the price is skyrocketing. With gold and silver prices soaring, these banks are facing billions in losses on their short positions. Every dollar the price goes up, their losses mount. This isn't just a small problem, it's a systemic risk that could have catastrophic consequences. In a crisis, there's no one. Everyone runs for the exit at the same time. We're looking at a 320 million ounce short position in silver. This isn't just a loss on a balance sheet, it's a ticking time bomb. If silver hits $50, the losses double. If it hits $75, they triple. And if silver reaches $100, we're talking about losses of $25 billion or more, concentrated in just 4 major institutions. This is why they've activated Tier 3 protocols. It's why recent stress tests have focused so heavily on precious metals. They know the bomb is ticking, and they have a 72-hour window to either defuse it or watch it explode. But it gets much worse, because these precious metals derivatives aren't isolated. They're connected to everything. This is the daisy chain of leverage, a web that links every major financial institution to every other one. When one bank fails, it triggers a domino effect. This is exactly what happened in 2008 with Lehman Brothers. When Lehman went down, it nearly took the entire global financial system with it. Here's how this doom loop works in the precious metals market today. Let's say Bank A is short 100 million ounces of silver. The price rises, and Bank A gets a margin call. They need to post more cash to keep their position open. But they don't have the cash, so they try to borrow it from Bank B. The problem is, Bank B is also short silver. They're facing their own margin calls. They have no cash to lend. So they try to borrow from Bank C, but Bank C is a European bank with its own set of problems. They desperately need dollars, but the Fed's swap lines are already overwhelmed. So what does Bank C do? They start selling their U.S. Treasury bonds to raise cash. When they dump those bonds, the price of treasuries drops. This triggers huge losses at Bank D, which was using those same treasury bonds as collateral for their interest rate swaps. Now, Bank D gets a margin call on their swaps, and they have to start selling assets too. Do you see how fast this spirals out of control? One margin call in the silver market creates a cascade that impacts treasuries, interest rate swaps, currencies, and eventually the entire global credit system. This isn't just a theory, this is the exact contagion risk the Fed's own research papers have described. And it's why the Fed just injected $43.7 billion this week. They're desperately trying to break the doom loop before it fully activates. But here's the fundamental problem. You can't solve a solvency crisis with liquidity. Liquidity is a temporary cash flow issue. It means your assets are worth more than your liabilities, but you just need a short-term loan. Solvency is different. It means your liabilities are greater than your assets. You are, for all intents and purposes, bankrupt. No amount of short-term lending can fix that. You need a bailout or a complete write-down of the debt. The 4 banks that activated Tier 3 protocols aren't facing a liquidity crisis. They are facing a solvency crisis. The value of their short positions has overwhelmed their ability to cover them. They are completely underwater. And the only way out for them is for the price of precious metals to crash back down, giving them a chance to close their positions. But the price isn't crashing. It's rising. Every single day, the hole they're in gets deeper. Every day, the ticking of the time bomb gets louder. 72 hours. That's the window. So, what can the Federal Reserve possibly do? They have 2 options, and frankly, both are catastrophic. Option 1, let the banks fail. This is the free market solution. The banks made reckless bets, manipulating the precious metals market for decades, and now it has blown up in their faces. Let them face the consequences. But if the Fed allows 4 of the biggest banks in the country to fail simultaneously, the fallout would be unimaginable. These banks hold 45% of all American deposits. Millions of businesses would lose access to their accounts. Payroll systems would freeze. Credit cards would stop working. ATMs would go dark. The social chaos would be immediate and severe. We're talking riots, widespread panic, and the potential for martial law. The Fed knows this. They cannot and will not allow this to happen. So that leaves option 2, bail out the banks. But this presents a huge dilemma. How do you bail out a bank that is massively short precious metals? In 2008, the bailout involved the Fed buying toxic mortgage assets off the bank's books. They transferred the bad bets to the Fed's balance sheet and held them. But you can't do the same thing with precious metals shorts. A short position isn't an asset. It's a liability. It's a promise to deliver metal that the bank simply doesn't have. The only way to close a short position is to go into the open market and buy the underlying asset, in this case, physical silver, and then deliver it to whoever holds the other side of the contract. This is the end game. The Fed faces an impossible choice. Let the system collapse into chaos or orchestrate a bailout that could trigger hyperinflation and destroy the currency. What if the four biggest banks all tried to buy back 320 million ounces of silver at the same time to cover their massive short positions? The silver price wouldn't just rise, it would explode. We're talking $50, $75, $100 or more. The very act of them trying to get out creates a feedback loop from hell. The more they buy, the higher the price goes and the more money they lose. So what's the escape plan? Based on emergency protocols we've seen, it looks like a three-step intervention. First, the Fed will print unlimited dollars to prevent a total market collapse. Second, regulators might change the rules overnight, maybe halting trading or jacking up margins to force you out. Third, and most importantly for you, a massive media campaign will launch to convince you that silver is a bubble and you need to sell immediately. They will use every trick in the book to scare you into selling your metal. Don't be their exit liquidity. Don't give them the physical silver they need to save themselves. You understood the system was fragile. The four largest banks in America have just activated emergency protocols. The Fed is scrambling as a crisis erupts from the precious metals market. The stress tests keeping bankers up at night aren't about housing or crypto. They're about gold and silver. For years, they called you a conspiracy theorist for believing in precious metals, all while they secretly suppressed prices and hoarded physical gold and silver for themselves. They told you to sell while they were buying. Now, their game is up. The physical market is overwhelming the paper one. There's not enough real metal to back up the contracts. The vaults are emptying and the system is running out of time. Each bank faces a unique threat. JP Morgan, the kingpin, holds immense physical silver, but is also the largest short seller. They're trying to play both sides, but it's backfiring. Bank of America is even worse off. They bet big against precious metals with massive paper shorts and have no physical hoard to save them. The system is breaking. It looks like some big banks made a huge bet, and they bet wrong. They thought that as interest rates went up, the price of gold and silver would go down. But the exact opposite happened. The metals rose, pushed up by central banks buying in record amounts and strong industrial demand. Now, Bank of America is reportedly sitting on a massive short position in silver. We're talking 50 to 70 million ounces, with no physical metal to back it up. That's pure gambling. It's what we call a naked short, and in a market where supply is getting tight, that's one of the most dangerous positions in all of finance. Citigroup is in a similar boat, but their problem is compounded by currency derivatives. They've written options on gold priced in multiple currencies. They bet that gold and the dollar wouldn't rise at the same time, but they did. Now, as the dollar weakens against real assets, those options are becoming incredibly costly. Their risk models failed them, and their hedges are actually making their losses even bigger. Wells Fargo's issue is a bit different. They aren't as exposed on the metals trading side, but they're deeply entangled in the collateral chain. They hold huge amounts of treasury bonds and use them as collateral for their derivatives. If this precious metals crisis causes bond yields to spike, which is a real possibility if the market loses faith in the Fed, then Wells Fargo's collateral suddenly loses value. They could face massive margin calls, not directly from metals, but from the ripple effects spreading to the bond market. This is what contagion looks like. It explains why all these banks seem to be in crisis mode at the same time. They're all interconnected. A problem for one quickly becomes a problem for all. So let's break down what could happen over the next 72 hours, based on historical patterns. In the first 24 hours, the banks are in emergency meetings with regulators like the Fed. They're laying out their exposure and asking for help. During this phase, you can expect the markets to be relatively calm. The banks will do everything they can to prevent public panic while they negotiate behind the scenes. In the next window, hours 24 to 48, we'll start to see the results of those meetings. Keep an eye on the repo market for unusual activity or unexplained spikes in short-term interest rates. The Fed might announce technical adjustments. If things are going well, you'll see a coordinated media push with CEOs and officials telling everyone, the banking system is sound. But if things are going poorly, you might see the first cracks appear. A smaller bank, reporting unexpected losses or a spike in the VIX, the market's fear gauge. The final window, hours 48 to 72, is critical. If the Fed successfully papers over the crisis with newly printed money, we'll return to a fragile sense of normal. And the mainstream media will likely never report on what really happened. But if containment fails, this is when the panic could go public. We might see trading halts in bank stocks, emergency weekend announcements, and the start of a bank run, first digitally, then physically at ATMs. I'm not predicting which way this will go, but both scenarios are on the table. The next 72 hours are pivotal. But no matter what happens, one thing is certain. Precious metals are at the heart of this. The shorts are real, the supply squeeze is real, and the long-term manipulation is coming to an end. So what should you do? First, don't panic. Panic only helps the banks and leads to bad decisions. Take a deep breath. Every ounce of silver and every gold coin you've acquired has been for a moment just like this. Second, and I can't stress this enough, do not sell your metals. In the coming days, You will likely see a massive pressure campaign to convince you to sell. The price might get temporarily smashed, and headlines will scream that the bull market is over. Social media will be flooded with accounts telling you to take profits. This is the final, desperate shakeout to get you to hand over your metal to the very banks that need it to cover their bad bets. Hold the line. Third, review your banking exposure. I'm not telling you to pull all your money out, as that could cause its own set of problems. But be aware, any deposits over the FDIC insurance limit are at risk if a bank fails. Consider spreading your cash across different institutions or converting some of it into other hard assets. Stay informed, stay calm, and stay prepared. The financial landscape is shifting right before our eyes. All right, here's what you need to be watching for. In the next 72 hours, forget what the banks say and pay close attention to what they do. If bank stocks start to tank for no apparent reason, that's a signal. If you see strange things happening in the overnight repo market, that's a signal. If the Fed suddenly announces emergency lending programs, that's a big signal. If they halt trading on precious metals futures, that's a signal. And here's the biggest tell of all. If you see a coordinated media blitz, politicians telling everyone to stay calm, and bank CEOs making the rounds on TV, that is the ultimate signal. It means they're terrified and desperately trying to control the story. But let's think bigger than just the next 72 hours. Whether this specific crisis gets contained or not, the root problem isn't going away. The banks have promised hundreds of millions of ounces of silver they simply don't have. Our entire global financial system is teetering on $189 trillion in derivatives, and those only work if prices behave as expected. They've been manipulating precious metals for so long that the whole system is now dangerously distorted. These problems don't just vanish, they get bigger. If the banks scrape by this week, they'll be facing the exact same crisis next month, or next quarter, only worse. The trend is obvious. The end game is near. What we're watching isn't just a banking crisis, it's a massive wealth transfer. For 50 years, ever since Nixon took us off the gold standard, the system has been quietly siphoning wealth from everyday savers and handing it to the banks and the government. They did it through inflation, manipulation, and 1,000 other little tricks most people never even noticed. But physical precious metals are different. They exist outside that rigged system. When you hold a silver coin in your hand, you're holding something real. It can't be printed into oblivion, it can't be defaulted on, and it can't be deleted with a keystroke. You're holding real, tangible wealth. The banks know this. That's why they've worked so hard to keep the price down and convince you it's a foolish investment. Every single ounce of silver sitting in a private safe is an ounce they can't control. Now, as the system they built starts to fracture, that wealth transfer is reversing. The value that was stolen through years of inflation is flowing back to those who saw through the charade and held on to real money. This isn't about getting rich overnight. This is about financial survival. It's about making it to the other side of this crisis with your purchasing power intact, while those who trusted the paper system watch their life savings evaporate. This 72-hour countdown isn't the end. It's the beginning of a whole new era. An era where physical reality is worth more than paper promises. An era where those who prepared will inherit what those who ignored the warnings will lose. You prepared. You stacked your silver. You held the line. And now your vindication is coming. That isn't as how long we have until we know if the system holds together or transforms into something entirely new. That's how long until their emergency measures either work or fail spectacularly. That's how long until the banks either stabilize or the cracks become too big to hide. But for you, the next 72 hours are simple. Don't sell, don't panic, and don't believe the headlines. The 4 largest banks in America have triggered their emergency protocols. The Federal Reserve is in a scramble. The stress tests are all focused on precious metals. The manipulation is coming to an end. Everything you believed in is being proven right. Everything they told you was wrong is being exposed. Everything they said could never happen is happening right now. 72 hours. And then the world changes. I want you to screenshot this video. Check back in 72 hours and see what's happened. And when the dust finally settles, when the mainstream media is forced to admit what went down, I want you to remember that you knew first. You were here. You were awake. The vault is sealed. The metal is yours. And no banking crisis, no manipulation, no emergency protocol can ever take that away from you. This is Vault AG. Thank you for watching. If this report woke you up, hit that like button, subscribe, and share it with everyone you know. The 72-hour clock is ticking, the banks are scrambling, and the stackers, the silver bugs, the holders of real money, we are about to be proven right. I'll see you on the other side. Stay stacked.